Good morning. Welcome to the Money Matters, the week ending January 16th, 2026. So today I'm going to cover some of the top changes, top tax law changes through the OBBA bill, which was passed July 4th, 2025. There's a lot of changes. This is my view of what some of the more key ones that are going to affect the most people. Before I get into it, this is not tax advice. This is changes that I looked up, researched, and read about. So make sure you consult your tax advisor for specifics. You're going to want to talk to them either way because there's a lot going on. Okay, here we go. So the first one is the change of really no change, and that is that the 7 standard brackets are the same. So we've got 10%, 12%, 22, 24, 32, 37. The one not listed is 0. All right, so good news, bad news here. Yep, we're keeping the same 7 brackets. Good news is they didn't go up, they didn't go down. They did have a marginal adjustment for inflation. But look, if we go back to like the 80s, there's no top bracket of 40 or 50 or even 70% like there was. So 37 is as bad as it gets at a federal level. And you throw in your state and your local and some of your other Medicare, and you're close to 45. But that's where we're at, similar to 2024. Now, 2026, the standard deductions are going up 32.2 for MFJ, which is married filing jointly, every time you see that in here, and 16,100 for singles in 2026. The theme when they started these changes in 2018 is they really want as many people as possible not to itemize. It's a cleaner, simpler, cheaper process to just whip people through the system. So a lot of people are itemizing. So I guess you could argue that that's working to some degree. Now, this one is a big change, I feel, and this I think is going to affect a lot of our clients. So in 2018, they put this cap in place, which limited your SALT deduction to $10,000. What SALT? SALT stands for state and local taxes. What generally gets affected in here is your property taxes, right? So some people maybe have 2 homes or have a large home, and they have, between state taxes, that's huge, and property taxes, they're way over this $10,000. When you go your tax return, you get this big number, but you can only deduct $10,000. So they've increased that to $40,000 effective 2025, but there's a catch, and all these are going to have a catch. There's phase outs. So if your modified adjusted gross income is over 500,000 in 2025, you're going to have it's going to reduce 30% by the access. So it's going to go down really quick. I ran an example on someone making 700,000. They're down to 10,000. So it's still a $10,000 minimum. But for those of you who are over 500,000, you're going to get down to that real low. Now, for those of you who are under 500,000, this is going to be a huge win because you might get an additional $30,000 in deductible SALT taxes. So if you own multiple homes or you have high property taxes, state income taxes, this could be a big win. Again, your accountant should, or your tax preparer, as you walk through these numbers, kind of explain how it would work, if it would benefit you. You do have to itemize to get this, but with the standard exemption being 32.2, if you're at 40 grand, that right there puts you over. Okay, another important change, not a huge win, but it's going to help a lot of people. Charitable contributions. You used to have to itemize to be able to deduct charitable contributions. Now you can take it what they call above the line, up to $1,000 a year if you're single, or $2,000 married filing jointly with your standard deduction. So if you're giving to nonprofits, this, that, or the other, you can take up to $2,000 if you're married without having to itemize. So that's a nice little win. This is a new one. First time that I've seen this in 20 some years. You've got a car loan interest deduction for cars new only purchased in 2025 and beyond. And so what you've got here is deduction of up to $10,000 of interest. Again, there's a phase out. This one's pretty tight. 100,000 for single, 200,000 for married filing jointly. Do not go buy a new car just to get this deduction. Okay. It probably still doesn't make it a great deal, but if you did buy a new car and you're under the threshold, make sure you're looking up the interest you're paying and report that on your forms so that you can get some of that deducted. Okay, this is probably one of my favorites. This is a nice one where my senior's at 65 plus. Let's go. This is $6,000, up to $6,000 per person. Okay, now a couple caveats again. You do have to be filed for and receiving Social Security. Um, and it's got a phase out, 75,000 for singles, 150,000 for married filing jointly. But if you're under that phase out, this is an additional $6,000 per person just for being you. We've ran some tax projections for a handful of clients already, and I've seen a lot of $6,000 and $12,000 additional deductions. So this is a great win. This starts in 2025. So you'll see this, hopefully a lot of you will, on this year's tax returns. This probably doesn't affect a lot of our clients, but I wanted to mention it. Maybe you have children, grandchildren, etc. Deduction on qualified tips. Now, the news will kind of say no taxes on tips. Again, everything has a caveat. Okay, it's up to 25,000, and again, there's a phase out. So if somebody is waiting tables and they've got another job and they're making over 150, or they're married and they're making over 300,000, it's going to start phasing out. Same thing with overtime. No taxes on overtime, not necessarily. Deduction for qualified overtime compensation, up to 12,500 per return, single, or 25,000 married filing jointly. Again, you've got a phase out. So best to just report all this and let the tax software and the tax pros figure it out. But make sure if you did have overtime, you can break out the difference. And then this is kind of nuanced. Mortgage interest deduction. So this is not new. It's up to $750,000 of interest is deductible. You do have to itemize. Okay. However, if you don't put enough money down, typically it's 20%, you have to carry this nasty little thing called primary mortgage insurance. And it's basically garbage, but the bank puts it on there in case you default, so they're protected. Primary mortgage insurance is now deductible. So if you did have to pay or do have to pay for primary mortgage insurance and you're itemizing and you're deducting interest, look for that number. Usually it's on your mortgage statement. Report that with your tax software or your tax preparer and get that extra deduction. And last but not least, estate tax and gift tax. Just a marginal increase here. I believe we're at $13.5 per person. It's now $15 million per person. So you can effectively gift $30 million to friends, family, me, and you pay no estate or gift tax on that money. That's your lifetime exemption. Okay. Remember, you've also got annual gifting, which I didn't list here, which is around $17,500 a year. Double that for a married couple that you can gift annually with no fuss and without using the basic tax exemption. So for most of you, you're going to be good with 30 million of wiggle room. If you're not, we're already talking to you, or we should be talking, because there are other ways we can mitigate that. So those are the main ones that we saw. There are lots of other nuances. Just to wrap this up for taxes, remember tax forms, the first tranche of them is due to you by the end of February. Now that's going to include Social Security, W-2s, annuity 1099s, IRA 1099s. It's not going to include brokerage 1099s. Those could be February, could be March. Save yourself some headache. And whether it's, you have all your investments with us, that's great. If you're with others, make sure you check with your advisor or online, and be sure you've got all your 1099s before you spend time going to your accountant and maybe having to spend more time and money than necessary. As always, thanks for watching. Have a great week.